The pullback, I think, is probably largely spent, if not totally spent. In fact, that was like a week or so ago. If you'll just notice what's going on, like weekly close to weekly close, we're wheel spinning. It's not really going down, down, down. It went down and then it's wheel spinning. When we examine the short-term technicals of silver, like the day-to-day, week-to-week type stuff, it's building a base, which you can't quite see it on the price chart, but on weekly momentum, I could see a clear ceiling that's been built, such that, I'll give you a number, it's tentative right now. You get these silver back above about 48.09 next week. Okay, we'll get one more day this week, okay? And I'm gonna break out of that base. So all you do is spin your wheels here. And I think that's what it's doing. I think it's next to meaningless. I know every time we get one of these, there's a whole crowd of internet analysts that say, oh, I gotta go to $40 or 41 or whatever, and this is this of the that and so forth. And I don't see it. I see it as a pullback buying opportunity. In fact, I'm making a list right now of miners to add to, because I'm shifting not just into silver related, but also the silver miners. As far as upside, the key trigger for us, and we've stated it over and over for the last month or so, has been the spread relationship between silver and gold. Not the net trend or the momentum of silver or gold, but the relationship between the two. Because we've examined back in the past, and when silver goes ballistic, and again, within that 50-year range, which is ridiculous, I'll comment on that in a minute, $50, $50, $50, the surge that got you up to those levels in the final phase of the 79 to 80 bull, or 2010 to 11, where silver went up fourfold in 5 months, or went up 2.5-fold in 6 months, 2010 to 11. The signal that generated that change in silver's verticality was when it broke out versus gold, the spread relationship, not evident on the silver charts themselves. Right now, the spread between silver and gold is at 1.2%. Divide D silver to D gold, express it as a percent. The major breakout level is not far above 1.3%. So it doesn't take too much to blow that spread through a multi-year high that anybody, even an amateur technician, if you only looked at the spread chart, you could see the ceiling. You clear that and we're gone. The ballistic tone will change from accelerated price tone that we've had for the last, 5-6 months, where silver went from the 30s up to the 50s, boom, boom, boom. Then it will go into that next phase. And we're arguing that silver is about to do, again, waiting on that trigger level, spread silver gold, to go into a new reality. And it's not going to do it incrementally. It's not going to go from here to $150, $200 or something like that in a matter of, a year or so. It's going to do it rapidly. When mistakes are made by a market, the overpricing mistakes or underpricing mistakes, sometimes they're protracted. We see bubble tops sit up there and froth around for a long time, and then finally they fall apart. And you look back and say, oh, gee, I should have known that. Okay. Similar at bottom. Sometimes markets get undervalued and investors just say, phooey with that market. It's, it's a dog. Don't touch it. And when it wakes up so fast they miss it. That's where I think silver is right now. Anyway, so right now, if I were looking at one single chart, I would say, look at the silver gold spread relationship and the momentum of that, which we plot every week in our weekend reports. The momentum of that spread, which requires going from like above 1.2 to 1.32% to be precise, to break out. Momentum of that is already pushing at the breakout levels. And usually momentum will lead a spread chart breakout. When that spread breaks out, it says something's beginning, okay? It's not saying, it's over. It's saying the race just began. And there's another spread that's very, very important. And that is between the gold measured against the U.S. stock market. And we've run numerous charts on that, especially last weekend's report where we went back to 2013. During that time, 11, 12, and 13, gold peaked and was headed down into a low that ended in late 2015. Well, obviously during that time, gold was underperforming the U.S. stock market because it was really going down hard. And therefore the spread was negative. Gold was underperforming. But since, I should go back 11 years now, but from 2014, that spread chart, when you divide the price of gold into the S&P 500 and express it as a percent and simply plot that chart month to month, has a massive, super clear ceiling on it that you're bumping and bumping and bumping. This is now for the fourth time, okay? Right now, the spread, if you divide gold into the S&P, is at about 58.5% price of D gold divided into S&P 500. If you ever close a month at 60%, you blow that entire structure out and gold breaks out to the upside. This is a fresh signal, which when that occurs, it's not old. It's not saying, gee, I'm an old trend. It's saying, I've just begun a major asset class shift. Now, when you do something else that we thought we should do in the weekend report, and sure enough, we were glad we did it. We know the S&P is distorted. It's like NASDAQ 100. In fact, you go to the top 5 or 6 stocks in both indexes, and you'll find that those stocks constitute 30% of the entire S&P 500. And you know what those stocks are. AI tech related. NASDAQ 100, the same symbols, 4 or 5 or 6 of them, constitute 50% of that entire index. So they're heavily front-end distorted. When we divide gold into the Dow Jones 30, or divide gold into the New York Composite Index, indexes people seldom look at anymore, we've already broken out. Whereas you've had that breakout. What it says then is that with the exception of those couple stocks, and by the way, look at those stocks today, they're getting hammered. Palantir, Nvidia, et cetera, far more than the market. When you lose those leaders and gold breaks out versus the S&P, joining its already existing breakout versus New York Composite and the Dow 30, it's saying there's an asset class shift that just occurred. It's new. It's brand new. And whenever gold breaks out versus the S&P and surges in performance, it always converts into net price gain for gold. So what people are talking about, gee, this has got to be over, it's gone ballistic, etc. Two things are wrong with that. One, the spread is just about to break out versus the major asset category, meaning the game just beginning. And secondly, gold is only fourfold off of its prior bear low. Back into its 79 peak, the 1980 peak in gold, and at the 2011 peak in gold, it had had an 8-fold bull market to get to those highs. We're only fourfold right now. So the game is not over. The game is just beginning.
If you've been watching silver closely over the past few weeks, you've probably noticed something curious. We've had this pullback, sure, but it's not really going down anymore. It's more like the market spinning its wheels, consolidating, catching its breath. From a momentum standpoint, that's exactly what you want to see before the next big move. This isn't the beginning of a collapse, it's the coiling of a spring. The correction, as far as I can tell, is largely spent, maybe even totally spent. Every time silver does this, pauses, retraces a bit, and starts grinding sideways, the internet lights up with analysts predicting it's headed to $40 or $41 or whatever arbitrary number they've plucked from thin air. You can practically set your watch to it. And yet, if you actually understand the structure of this market, you can see that this kind of pullback is exactly what precedes the next phase higher. It's a buying opportunity, not a warning sign. Technically, silver's building a base right now. You might not see it clearly on the price chart yet, but on momentum, it's there. Momentum always leads price. On the weekly indicators I follow, I can see a very clear ceiling forming, and I'll give you the number, around $48.09. That's the threshold. Get silver back above that level next week, and it breaks out of this base. That's when the real move begins. What we're seeing right now is a lull before ignition. Silver went from the mid-30s to $50 in just a few months earlier this year, a massive run. This sideways action is simply the market digesting those gains, shaking out weak hands. Once we clear that breakout point, I think silver goes ballistic again. But here's the thing. I'm not just watching silver in isolation. I'm watching its relationship to gold. Because the spread between the two metals, that ratio, is one of the most powerful leading indicators we have. History shows that when silver really takes off, when it goes into those vertical parabolic phases, like in 1979 to 1980 or 2010 to 2011, it's always preceded by a breakout in the silver to gold spread. Let's look back. In late 1979, silver went up fourfold in just 5 months. In 2010 to 2011, it doubled in half a year. Both times, the key trigger wasn't visible on silver's own chart. It was in its performance relative to gold. Right before those moonshots, the spread between silver and gold broke out of multi-year resistance. Today, that same spread sits right on the edge again. It's currently around 1.2%. The major breakout level, roughly 1.3%, that's it. Just a small nudge higher, and the ratio explodes through a multi-year ceiling. You don't need to be a charting expert to see it. Any amateur can look at that spread chart and spot the level. Clear it, and the entire character of this market changes overnight. When that happens, silver doesn't just drift higher. It revalues itself. It goes from strong to uncontainable. And the reason is simple. Silver has been trapped in a 50-year range that's frankly absurd. $50 in 1980, $50 in 2011, and now, here we are again. Meanwhile, every other commodity, copper, lead, zinc, even tin, has long since broken out of its old ranges and multiplied several times in price. Silver's the only one still sitting at the same number it hit when Jimmy Carter was president. That's not a coincidence. That's decades of manipulation, distortion, and underpricing finally catching up to reality. Here's what I expect. Once silver breaks above that $48 to $50 region decisively, the market won't crawl to $100 in 5 years. It'll sprint. When a market's been suppressed that long, the revaluation happens violently. It's not linear. The pendulum doesn't stop at fair value. It overshoots. We're talking triple digits in months, not years. I've seen this pattern before. When a market has been ignored, dismissed, and underpriced for too long, it becomes a coiled spring. The longer the neglect, the bigger the eventual explosion. Investors say, "Oh, silver's a dog, it never goes anywhere." They'll say that right up until it breaks out. And then they'll all chase it at $75, wondering how they missed it.
There's still, you could tell by looking at the hour by hour action sometimes of silver and gold versus the S&P, especially silver, because some people connect it only as an industrial metal, and therefore if the stock market goes down, silver must too. Okay, they're making a mistake, okay? But you can see it in the hourly ticks where the short-term traders say, "Oh, S&P just dropped 5, let's sell silver off, it drops 25 cents, and the game is going on still. It's a wrong thought process, because when you stand back and look at the bigger picture, take for example, S&P made a high January, February, it collapsed into April, 20% drop. What did gold do during that time? It exploded, not hour by hour, but month by month, okay? So the S&P had a sharp, cataclysmic 20% drop. It scared most people, most of that occurring in several weeks of March and April. So it was really, almost crash-like. And yet gold went up, okay? So people need to rethink that assumption, because it will trap them into missing something.
No, when we also look at Bitcoin, I know we've been seeing Bitcoin really collapsing in price recently, which is something that you've been predicting. What do you anticipate, and what is the momentum showing on the Bitcoin chart right now?
Well, we showed this over the last months, and especially back in a September report, we showed an overlay of the S&P 500 back in 1987, when it had been going up and up, and the price chart just looked lovely. Momentum had built a floor spanning a couple years where the price was going up, there was rising lows, but momentum was making the same low over and over and over again, where it was dropping down, the price was dropping down to its rising 3/4 moving average, and therefore the oscillator showed a repeated drop to the zero line, okay, a flat floor, a structure. When it broke it, it crashed. Didn't even wait around for the end of the month close to break it. It broke it intra-month, gone. Okay, this is the 4th time that Bitcoin since 2023 has dropped down to its 3/4 average. That number this quarter is 101,390. Okay, we've been trading below and above that for the last few days, so we've come down to that structure again for the 4th time. We don't think it'll hold this time. The question is, do you wait for a monthly close below that number? We got a long way to go to the end of November. Or do you maybe assume this time, don't wait, it's not going to hold, just like in 87 for the S&P. That's our assumption. Now, does it have to crash? No, I'm not going to argue that. crash, meaning like 30% in, a matter of a week or so. But it's a disastrous number regardless. And, it wouldn't shock me that when you break this, that 3 months later or maybe 3 weeks later, you see that the Bitcoin, which by the way is highly correlated to the month-by-month price action of NASDAQ 100, is 30% or lower below where we are now, meaning you could be 70,000, 60,000 or something on Bitcoin. Remember, its recent high was 127. It could cut you in half, much of it occurring rapidly. Now, the problem with Bitcoin doing that, aside from proving to the gold doubters that Bitcoin is an alternative to gold, which it is not, but it's linked to the stock market. Its inhale-exhale behavior since 2021 on Bitcoin monthly bar charts versus NASDAQ 100, it's practically an overlay. They look like brother and sister. In fact, we ran those charts and removed the name on the chart and the price scale, and you can't tell the difference hardly.
Here's the thing about markets. They're not logical, they're emotional. They don't move because of data, they move because of beliefs. And for 40 years, investors have believed in the omnipotence of central banks, in the idea that you can print prosperity forever. That belief is cracking. The Fed can jawbone all it wants about soft landings and long-term inflation expectations. The reality is simple. The U.S. is $35 trillion in debt, running multi-trillion-dollar deficits, and losing control of the bond market. Every time the Fed cuts rates, yields rise instead of fall. That's not policy working. That's policy failing. The bond vigilantes are back, and they're calling the bluff. When that happens, when the world realizes that the emperor has no clothes, money flees to real assets, and that's where gold and silver come in. Silver's role here isn't just as poor man's gold, it's as the tell, the leading indicator of systemic stress. When silver starts outperforming gold, it's not a random event. It's the market screaming that confidence in the monetary system is breaking. That's why I watch the silver-gold spread so obsessively, because it's not just about price, it's about trust. When that ratio explodes, it means investors are abandoning financial assets and rushing into tangibles. It's the early warning siren of a monetary reset, and we're right on the cusp. If silver pushes just a bit higher relative to gold, through that 1.3% threshold, the floodgates open. Momentum on that spread is already leading higher, just like it did before every major silver bull run in history. Momentum breaks first, price follows. Once the ratio goes, silver will move so fast that most investors won't even have time to react. I've said this before. Markets can stay undervalued for years, even decades. But when they finally wake up, they don't politely knock. They kick the door in. The biggest price moves always happen after the longest periods of disbelief. And that's exactly where we are now. We've had 13 years of underpricing, manipulation, and neglect. The world has consumed 5 years of silver deficits in a row. Inventories on COMEX and LBMA are at multi-decade lows. The industrial demand curve is going vertical thanks to solar, EVs, and AI infrastructure. Meanwhile, the monetary backdrop is deteriorating faster than at any time since the 1970s. Put all that together, and what you get isn't just a bullish setup, it's an unavoidable explosion. And here's the kicker. This isn't going to be a slow grind to 75 or 100 silver. This is going to be a repricing event. When you have a structural error that's persisted for half a century, the correction doesn't happen gently. It happens violently. I'll give you a parallel. Copper and lead, both traded in narrow sideways ranges for decades, from the 1970s to the mid-2000s. Then in just a few quarters, they quadrupled in price. Not because demand suddenly quadrupled, but because the market finally recognized reality. The same thing's about to happen to silver. The fundamentals justify it, the technicals confirm it, and the psychology guarantees it. Think about this. Silver is still priced roughly the same as it was in 1980. But since then, the U.S. money supply has increased by 40 times. If silver simply matched its 1980 high in real purchasing power, adjusted for M2 expansion, it wouldn't be $50 an ounce. It'd be over $200. That's not hyperbole, that's math. And yet, here we sit, watching the same financial media that missed every major turn in history telling you that silver's overbought. Overbought compared to what? Fiat paper that's losing 10% of its purchasing power annually? No, silver isn't overbought. The dollar's oversupplied. When the breakout comes, and it's coming, it won't look like a normal rally. It'll be a stampede. The same analysts who mock silver at $30 will be calling for $150. The same hedge funds that shorted it for a decade will be scrambling to buy it back. The same institutions that ignored it will be tripping over each other to secure physical inventory. That's how every paradigm shift unfolds. First they ignore it, then they ridicule it, then they chase it. And remember, this isn't just about price. This is about what silver represents. It's about the loss of faith in the system. When silver moves, it's not just a commodity story, it's a referendum on fiat. That's why I always say silver isn't about getting rich. It is wealth. It's the antidote to paper. As for gold, it's quietly doing what it always does, preserving purchasing power while the rest of the financial world convulses. But this time, gold's move is part of something bigger. It's part of an asset class migration. Look around. Stocks are at record highs in nominal terms, but hemorrhaging in real terms. Bonds are in their first bear market in 40 years. Cryptos are imploding again. Real estate is wobbling. Where's the money going to go? It's going to go where it's always gone in times of crisis, into real money. And this isn't just individual investors. Central banks are already there. They've been buying gold at the fastest pace in 55 years. That's not speculation, that's preparation. They're hedging against the collapse of the very system they helped build. The question is, will individuals act before or after the reset? The window to position is shrinking. Every week, we're closer to that 1.3% silver-gold breakout. Every month, we're closer to gold breaking out versus the S&P. Every day, more cracks appear in the financial architecture. When those charts trigger, it'll mark not just a market shift, but a monetary epoch change. And here's the best part. You don't have to be early by much. You just have to be there. Because once it starts, it won't stop at fair value. It'll overshoot. It always does. Markets don't correct to equilibrium, they correct through it. So when the silver to gold ratio blows through 1.3% and the gold to S&P spread closes above 60%, you'll know the signal. That's the starting gun for the next global asset rotation, out of paper into metal. That's when the mainstream finally wakes up and says, wait a second, maybe gold and silver weren't relics after all. And for those who already understand this, who've been patient, who've ignored the noise, that will be the moment of vindication, because this isn't just another bull run. This is history repeating itself. And this time, the move won't stop at $50 silver or $2,500 gold. Those numbers will look quaint. When you've suppressed reality for 50 years, the truth doesn't come out in inches. It erupts in miles.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.